Warren Buffett is arguably the best investor in the world. He's got a net worth of $102 billion and he's one of the top 10 richest people in the world as well. Learning from great investors and understanding the process they go through when picking their investments is an excellent way to boost the quality of your own investments, maximize your returns, and help you avoid some very common investing mistakes. If you find the video helpful, make sure to help me out by dropping a like to help support the channel and subscribing so that you can stay updated with future content. In today's video, I'll be sharing my top 5 Warren Buffett principles. I've based my list on various interviews that Warren Buffett's given and his annual shareholder letters. I'll be referencing these throughout the videos. I'll break it down into 5 key points with links and resources down below in the description box. So feel free to check those out if you want to watch the original interviews or read the shareholder letters for yourself. The first tip is not to invest with your emotions. When it comes to investing, it's easy to get caught up in hype and just buy stocks because you see the price going up or sell them because the price is falling. You really want to be investing based on facts and not just your emotions driving your buying or selling decisions. It will eventually cause you to make bad investments that will lose you money. A great example of this is some of the meme stocks that have come about, like GameStop, AMC, BlackBerry. They saw massive spikes in share price, but there were no fundamentals driving it, like sales, cash flow, or revenue. It was just hype and speculation driving up that stock price, and lots of people were caught up in the euphoria and bought into these kinds of investments. Of course, there will be people that made a lot of money along the way, but you don't know at which point you were buying. Were you buying right at the bottom, the middle, at the top? And this ultimately caused a lot of people to lose their money as well. When you invest, you just want to be investing on the financials. These are the fundamentals of the business that will show you whether or not it's actually worth putting your money into. These are factors like the cash flow, the revenue, the sales, the things that show the financial health of that business and how confident that you can be that the investment will be profitable for you. These indicators will show you the health and longevity of that business. Because investing is a long-term thing, you need to find a company that will hold its value and grow over time, because essentially the business is just a cash producing machine, and these figures will help you determine on how effective that company is at making money. If the company is making money effectively and consistently growing and using its finances appropriately, then it will also use its investors' money effectively and help them make a return.
That's something that you should do, and that's the safe way of doing it. What are they missing?
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it goes down?
Selling a stock because it goes down. Some people are not actually emotionally or psychologically fit to own stocks, but I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become.
Number 2 is understanding a business. For the majority of people that aren't used to investing, whether they buy or sell a company is if the stock price is going up or down, but that doesn't tell you anything about the fundamentals of that company. When it comes to understanding a business or an investment, you need to know how that company makes money. For example, Facebook makes the majority of its income from running Facebook ads, so you need to make sure that the company is growing. Are the monthly active users increasing? Are there any upcoming laws or legislations that might negatively impact Facebook's ability to play ads to its users, potentially ones related to privacy that might limit Facebook's ability to track information about its users? And the less information that Facebook has, the less accurate its ads will be. Therefore, people who are currently paying Facebook to play ads might be less likely to, because the quality of what ads are played to users might not be as effective. Therefore, there's less sales made from the ads that Facebook shows to people. These are all the things that you need to keep in mind. Who are its competitors? With Facebook, it's Google in regards to the ad space. How well is its competitor doing? Is it potentially going to take over that company or negatively affect their sales, overall reducing that financial health of the business you're investing into? You need to make sure that company is going to be financially strong and viable, not just 1 or 2 years into the future, but 10, 20, 30 years ahead of time. And a great way to see how a company is run and the financials for it is something called a 10K report. Now, all major investments have this, and it's essentially just a large financial financial document that gives you lots of detailed information about a particular business, from how it makes its money, any financial issues that it's had, how its management runs the business, all of this key information that you need as an investor to make sure that the company is financially viable and is going to be a good investment for you. Because stocks aren't lottery tickets, there's a reason in the long term why the price goes up. In the short term, it can be largely related to popularity, but in the long term, every company is weighed, and whether or not it's actually worthwhile to put your money with a company will be shown over an extended period of time. Again, that 5, 10, 20-year period. That's why particular scandals with a business can drop the overall share price, like Cambridge Analytica with Facebook. When Facebook was getting in a lot of trouble about its privacy laws, we saw a big drop in the share price of Facebook. However, there was no harm to the actual core fundamentals of that company. It still had its monthly active users increasing consistently, and then over time we saw that Facebook bounced out of that drop in share price. It was really just a bad publicity sort of thing and not an actual negative impact on the core fundamentals that drive the value of it. Number 3 is that the management must have integrity and talent. The management is ultimately the people that run a company and are the ones that are in charge of making the major decisions that will affect how that company is run. So you need to make sure that the management team is honest with its investors and doesn't hide things from you and is upfront if there's any problems in the company. A great way to see this is in the investor relations report, the 10K reports. You can tell by the language that they use or what they do or don't say, will dictate if they're happy to flesh out or show you what's wrong with the business and actually tell you what they're doing about it, instead of just trying to sweep things under the rug. You can also see in conference calls where CEOs will have public events where investors or news teams can come to and talk to them about how the business is running, and you can see from how they're answering questions if they're being honest or upfront, if they know the answers, if they tell you that things are going wrong and saying how they're going to fix them and not trying to dodge questions or just change the topic. You can see how invested they are in the company, if they know what's going on and actually are aware of the issues that might be facing their business, and they're happy to discuss those and not try and hide anything to try and make it seem that things are better than they really are. Another way is looking at the previous companies that they've worked at or potentially other businesses that they've run. For example, Elon Musk was involved with PayPal before moving to Tesla, so you know that he's got some managerial experience with very large companies. Another thing is the payment scheme for the CEO. Do they just have a large salary that's paid to them regardless of how the business does, or is their salary tied to how well the company is performing? And also, if they are a founder of the company, if it's something that they had to make with their own 2 hands or they were directly involved in the production of it, then you know that they are going to care more than someone who's just come in to fill the shoes of the CEO. If you have someone who's just come into a company, they weren't part of the original management team, they are just on a salary that's paid to them regardless, and they just dodge all the questions and aren't honest in the reports, you know they're most likely not going to be a good CEO for that business. Number 4 is taking an opportunity when it comes. The biggest losses in the stock market aren't the percentage returns that you lose from making a bad investment, but it's the investment opportunities that you don't take up. One of the biggest ones with Warren Buffett is not holding his investment with Disney. He sold it far too early and he could have made a staggering return if he had just held on to it. Make sure you do your research on a business, and if it does look like a buy to you, then go ahead and purchase it, but be confident in what you're doing and don't let opportunities pass you up, because ultimately that's what you'll be kicking yourself for, as opposed to being too timid and sitting on the sidelines and just watching a good opportunity pass you by. Number 5 is paying the right price for a company. When it comes to investing, much like anything else, you can pay too much, too little, or just the right price. So if you had a car that you knew was worth $5,000, you're not going to pay $8,000 for it, and if you got it for less than that $5,000 mark, which is what it's valued at, say for $3,000, then that would be ideal. That's what you would want. You want to pay less for something than what it's really worth. Stocks are just the same. With investing, buying something at a discounted price is called your margin of safety. Think of it like your safety net, that if you make any incorrect calculations or errors when you're valuing a company, that margin of safety, that safety net, is there to protect you. Margin of safety is expressed as a percentage, and you're ideally aiming for 30 to 50%. So if you're getting 50% off on your investment, you're essentially getting $1 of value for paying 50 cents. So think of it like this: if you've got a company that you know based on your calculations is worth $100, you want to be paying $50 or $70 for that business. So if the price of that company is sitting at $120 or $130, you wouldn't want to buy it, because then you're paying 20 to 30% too much. So how do you go about calculating the intrinsic value or the true value of a company so you can make sure you're getting it at that margin of safety or that discounted price? A great website is simply Wall Street. You can make a free account, and then if you scroll down to the bottom, it'll give you a chart of whether or not that business is at the correct price. So it'll give you a green, orange and red rating, and that pre-calculates it for you. It is quite a long calculation to make to find the intrinsic value of a company, but I'll leave a video link down below in the description that'll give you an exact step-by-step guide if you want to crunch the numbers for yourself. That margin of safety just protects you and makes sure that you're not making a bad investment, and accounts for any errors you might make when you're calculating a company, and just make sure you're not paying too much for a business than what it's worth, because if you're paying more for something than what it's worth, essentially you're losing money as opposed to making it. So the bigger the margin of safety, the better, and the more profitable your investment will be. Now that you're familiar with Warren Buffett's top 5 investing principles, you might still have some concerns about the risks that can come with investing. The learning curve is very minimal, and it's not as complicated as you might think. You don't need a lot of money to get started, or have a background in finance, or have lots of time to research companies. The whole process is a lot more straightforward than you might think. And if you're worried about some of the risks that come with investing, check out this video on screen that'll give you an exact step-by-step guide of some key mistakes to avoid and help introduce you to the stock market. It'll help maximize your returns, and it'll show you a lot of the mistakes that I went through when I first started with investing, and it's the video that I wish I saw before I got into it.